that there are some signals out there that show us that the recovery could be slowing down, at least for a while. For example, I think it's interesting that copper, which is a good bellwether of industrial production and global recovery, it has basically reached a top and is moving to lower highs little by little. I think it's also quite evident that we see that the strong rise in iron ore, copper, and also oil is started to be coming off in the last couple of weeks. And I think that that is important because it comes fundamentally from weakness in Asian demand. So it looks like Chinese buying is slowing down, and there obviously might be a seasonal effect, but in a world in which investment banks and investors are betting so aggressively on a very robust recovery, these little signals that show, that the economy might be growing at a slower pace than was initially expected, particularly in Asia. No, I think that if we look at the slowdown in buying of commodities, energy commodities, and industrial commodities from China, that might be a signal of a slowdown, both from the exports of China to the rest of the world due to the Eurozone slowdown, but also because the trade growth that was so highly anticipated might be slower than expected.
Could it be because you mentioned, everybody it seems is speaking about inflation, the reflation trade, I believe, and some commentators were saying that a lot of these commodities may have been just overbought, people overbuying them in anticipation. You think it could just be a correction, a pullback maybe?
I think it's an interesting point. There is obviously an important physical element to the trade that we have seen, and the activity from physical buyers, from traders in the energy space in particular has been very, very strong. But I agree that obviously you have seen big inflows into ETFs of commodities and commodity-linked products. So I think that we probably could see some unwinding of that trade after its a strong run at the beginning of the year. A few people are saying that the inflationary trade might be 1 month away from its end, or that basically the level of increase in the price of some of the commodities basically has run its course for what was expected to recover in 2021. I think that what I find more interesting, however, is that in the physical market, you do see a slowdown coming from Asia.
Interesting. You mentioned China. We see that the yuan has strengthened considerably in the past year against the dollar. You and we spoke recently as well that China, at least they're saying, they're going to take a less aggressive quantitative easing, interventionalist, probably print less yuan than dollars. So what happens if the yuan continues to rise in value, strengthen against the dollar, if the United States continues with QE? What does it mean for Chinese exports and the kind of this balance of things?
A rising yuan puts a lot of pressure on Chinese exports, particularly because most of the goods that they export are not going to be as competitive as they were before. A relatively weak yuan has helped the massive trade surplus, particularly with the United States, that China has enjoyed. However, I think that the Chinese central bank and the government find themselves in a very difficult situation because on one side, the export market might suffer from a strong yuan, but at the same time, they cannot go out and devalue the yuan because they risk being considered a currency manipulator by the US administration, and as well, they need to strengthen internal demand. So weakening the yuan would be very bad for real wages and disposable income of the citizens in China. So it's a double-edged sword. Is that they're starting to see that the allegedly competitive benefit of having a weak currency is very detrimental for the internal demand growth uh, in China, and that having a strong yuan might have a very, very significant impact on the exports, particularly to developed economies.
Mm. The currency manipulator label, we spoke a little bit about this before as well, but I see Taiwan are worried that they might get slapped with this currency manipulator label because they're running, high trade surpluses, that their currency is strengthening against the dollar. They're afraid they'll be called a currency manipulator. So how does this actually work?
Usually, what the United States does in order to consider that a country is manipulating the currency is to look at a combination of factors, which include the level of trade surplus, the level of weakness of the currency relative to the US dollar, and the level of intervention that the central bank of the country is taking relative to the US dollar. That is, whether the central bank has been selling aggressively reserves in US dollars or things like that. No, it's not an easy thing to do to label a country a currency manipulator in the world of constant currency manipulation that quantitative easing is. However, it's basically a very expansionary policy to artificially trying to depreciate the currency when the fundamentals of the economy would actually dictate that the currency should be strengthening, or should be strengthening more than what it has been imposed. And it's a big challenge to understand how it really works.
So after all the QE we saw over the past year across the world, really, what's been the most significant thing we've seen?
I think that the biggest and most significant element that we have seen after the massive liquidity injections of 2020 is the return of inflation, particularly the return of inflation in fresh food, in commodities that are linked to industrial production, and everything that has to do with energy. I think that is the biggest surprise, probably, to a view that was generalized, that we would see a very subdued recovery of inflation despite the economic recovery after the reopening. What we have seen is that emerging economies have prices, a very big increase in the input costs of manufacturers, but because overcapacity remains, they're unable to pass those input prices to final prices. So I think that is the biggest lesson out of 2020, that central banks have been pushing the limit of monetary policy, and they certainly did massively pass what was viewed previously as very aggressive monetary policy in 2020, and now we're starting to see the consequences in those factors. I think that despite the headline CPI not being very high, what we are seeing is that, I come back to the point, fresh food, that energy commodities, and that input prices are rising much faster than economic growth, than margins, and definitely than real disposable income of households.
So on the CPI, at least the government's official, tracking of inflation, is it something you use in your analysis? I know a lot of analysts say that it's underestimated.
Yes, I think that we have to be aware that headline inflation significantly underestimates the real cost of living of most households, particularly once we look at the goods and services that we purchase on a day-to-day basis. Think about this: the basket of CPI puts together as an average the price of hospitality, technology, etc. Prices that come down with fresh food and other elements that actually go up. So what we see is that there is a lot of inflation in the things that we actually purchase. Any US citizen can understand what I'm saying when I say that healthcare, education, rent, and fresh food have risen significantly faster than real wages and than real disposable income. No? So I think that this is an important thing, is to understand the important differences by segment of the population as well, between the poorest segments and the richest segments, of what inflation really is, in order to understand as well where retail sales, consumption, and savings are going to go, particularly in an environment like the one in which we live today, in which a big part of the market participant community is betting on a huge increase of consumption. Because if we as households perceive the pinch of inflation in the things that we purchase on a day-to-day basis, and the essential goods and services, while the Fed tells us that inflation is still too low, there's going to be a discrepancy between expectations of consumption and the reality. I, as the head, as the father of a family, I'm not going to spend a lot more if I feel, as I do, that fresh food, insurance, education, healthcare, and the utility services that we pay on a day-to-day basis are rising faster than my real wages and our disposable income.
So it's not a case that inflation is necessarily incredibly difficult to calculate. It's a kind of there's political motives to keeping it low, you feel?
There is always an incentive from governments to try to adjust the way that the basket is calculated in order to bring inflation down. And it's very simple, no? The economist that created, or one of the economists that thought about the basket that we call CPI today, was Irving Fisher, who was extremely angry about headlines of bread rises 10%, sugar rises 10%. So he created a basket of the goods and services that people buy on a daily basis in order to make people understand what their real increase in prices was of the things that they bought. Now, as time passed, governments have an incentive to increase the percentage in the basket of things that we purchase more discretionarily, like, for example, leisure, hospitality, restaurants, technology, relative to the things that we purchase every day. Bread, food, and that creates the discrepancy between the perception of cost of living that we have as citizens and the official inflation. It doesn't mean that the official inflation is wrong. It's just that you are comparing things that you purchase once a year with things that you purchase every day, and that might create between the perception of households of the cost of living and what economists think. So we need to be more granular as economists, and policymakers need to be more granular, because you look at headline CPI and then you add a core CPI, which is excluding food and energy, don't you? However, that is still too generalistic and too much of an average. I think that we need to be a lot more granular about things that are rising very fast, particularly housing, healthcare, education, things that are really important to all of us, and that appear in a very subdued way in the inflation figures. So it's a fantastically exciting concept for an economist to talk about the different elements of inflation. But there are important studies, and I think that this is the critical part, about how consumption patterns have changed in the crisis, in the COVID-19 crisis, and how that means that basically the inflation that the poorer segments perceive is much higher than that of the richer segments, obviously, because the poorer segments of society are feeling an inflation level that is probably up to twice what the headline CPI is. So we need to understand that inflationary policies themselves can be extremely detrimental to things like inequality and improvement of the position of the middle class and the poorer segments.
And why is it that new money goes into these essential goods and services before it goes beyond that?
Well, obviously, you have things like technology in which competition and innovation generate significant disinflation. No, this computer that I'm working with right now is probably worth 50 or 60% less than when I purchased it. There's nothing bad about that. No, this camera that I'm using right now is extremely cheap compared to how expensive it was 2 years ago. So technology disinflation is extremely positive for because it comes from competition and it comes from innovation. However, there are non-replicable goods and services that rise significantly faster than real wages and real disposable income. And it's not because of magic things. It's because of monetary debasement. Because those non-replicable goods and services, as I mentioned before, the ones that we cannot decide to purchase at a later stage or things like that, all of those are suffering from the increase in money supply. So it's very simple. If you debase the currency and the production of the good is valued in that currency, the price of the good rises, but nothing has happened. It's simply the debasement of the currency. Think about sugar, or think about, I don't know, even oil. No, oil goes up because the dollar goes down because it's denominated in dollars. Then that increase in price is actually not an increase in price, it's a debasement of the currency. See? So that's the reason why emerging markets see much higher inflation that comes fundamentally from the debasement of the fiat currency. Now, it's no surprise that Argentina has 40% inflation annualized with a 31% increase in money supply. And it's no surprise either that the inflation of most emerging economies is rising faster in those economies that depend more on goods that are denominated in a local currency that is debased.
So basically, it's just market forces. Increase the liquidity, increase the amount of money, and obviously people bidding against each other will push the prices up of these particular commodities. No?
Yeah, inflation is always and in every element a monetary phenomenon. It is always a monetary phenomenon. There is no such thing as inflation if the amount of money is not rising and the purchasing power of the currency is strengthened. So inflation is always a monetary phenomenon. The only thing that you can do is to have this quid pro quo that developed economies have of what they call moderate inflation as a way of slowly and gradually reducing the debts of the developed economies. But it's still a monetary phenomenon. It's and that is why we need to understand, because inflation is created where money goes. So inflation is also seeing bonds go through the roof and yields through the floor. And inflation is also seeing multiple expansion in equities, because inflation is generated where money goes. No, so that's what we need to understand. Obviously, in sectors in which competitive forces are enormous, like technology, as I mentioned before, then you don't see that level of inflation. But in the goods and services that are priced in a currency in which the costs are priced exactly the same, you don't have an increase in price for anything. It's a monetary phenomenon.
Very good. Daniel, really appreciate it as always. Thank you so much.
Thank you so much.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.